What's up, everybody? I hope that you're having a fantastic day. Today, we are going to do something super exciting. We are going to track everything that's happening right now. We're gonna have the interest rate decision we're gonna have that being announced very soon here. We are also going to have a speech by the Fed, and that is actually taking place after the interest rate decision. So today we are going to go through all of this. We're going to watch the markets. We are going to maybe get into some trades here. As you know, I do have a trade I'm looking to enter here at the orange box, so we will see about that, guys. But more than anything, guys, I hope that you've been having a fantastic day, morning, evening, wherever you are. How about you let me know where you are watching from in the chat and everything, and let's see if we have some people going in here. Let me know if the sound is all right, if everything is set up well. Okay, we can see a couple of guys getting in here. So this is going to be super exciting. I hope that you are stoked about this, guys. I will tell you that I do have the FOMC meeting. We do have it right here, as you can see. So once the FOMC meeting actually goes live and we can see the Fed, Jerome Powell speaking, I am going to cover that live here as well. So I'm going to be reacting to everything he says here. Of course, everyone are asking themselves, are we going to get that pivot now? Is enough already? Are we going to have a stop to these interest rates being increased? That is going to be something to watch out for. We're also going to, of course, be looking for different clues as to what the Fed, I believe, is going to happen for the foreseeable future here, because that is going to be very interesting. And we got a very interesting evening ahead of ourselves, guys. Let me just watch real quick so that everything is in line here. Let's see. I will also add a little bit of music, guys. So I will turn this on and let me know if the sounds are set up correctly or if it's too high or too low or whatever. Meanwhile, I will try to see here. I just want to make sure that the live is actually running on YouTube. Too low. Okay, so let's turn up the music a little bit. I don't want it to be too loud. I don't want it to take over the entire thing, you know. So we'll just have to adjust this on the go. So Romania, Pakistan, Mallorca, nice. We do have Nottingham, we have the UK, we have everything. People are confirming the sound is okay at least. So how about the music? And also let me know what you think is going to happen here with the interest rate decision itself, and also, of course, the speech by Powell. Do you think that by the end of tonight we are going to be at a higher level or at a lower level than where we are at right now? Okay, so people think that the music is fine now. So let's talk about the charts, guys. So on the 4-hourly time frame, what you do have is, let me make this a little bit, I don't want this to be too big, but we can make it a little bit bigger here. You do have this dashed line where we, of course, are having this trend line going down. And this is, of course, the first level of resistance here. So if we have a pump based off on the FOMC meeting, then you can expect a move out of the triangle here, which is going to take us to the next level of resistance. By the way, this one is at, let me see here. So it's currently at about 20,500. Abu Dhabi, Dubai, nice. Which parts of Dubai? So we do have this, and the next level, should we break above this level, guys, we do have the 100-day moving average, which I've been talking about so much. I feel like a broken record already, but we do have the 100-day moving average, which is the purple line, and this is actually a level that has been very strong resistance here. So we have hit it, well, 1, 2, let's call it 3, 4, 5, 6, 7 times already. We've been rejected off of the 100-day moving average, the purple line here. So this is the next level of resistance. It is, let me just see here. The reason why I stop a little bit is because we are seeing some footage from the Federal Reserve live stream here. But this is not, like, it's not happening yet. So as soon as we do see that happen, guys, I will turn on the meeting, but give it another like 20-30 minutes before that actually happens. So these are the resistance levels, and of course we're going to be watching the charts here. The consensus right now is for us to have a 0.75% rate hike. So 88% believes that. I think that that is going to be the case as well. So I would be very surprised if we see something other than a 0.75 basis point rate hike. 11% for a 0.5 rate hike. How likely is it that we are going to see a, so this is 0.5, this is 0.75. How likely is it that we are going to see a 1% rate hike? It's not likely. I mean, according to this, it is a, like literally a 0% chance that we could see that. But here's the thing. The data that have been coming out recently has been showing us that the economy is pretty strong. And as you know, the Fed really wants to see a weak economy. The Fed wants the economy to be in shatters, because if people are, you know, losing jobs, they're losing, like they're paying a lot to stay alive, basically. That means that they are just like, they're putting all of their money into just getting by. They're not spending a lot of money on luxury and like travel and stuff like that, leisure. So they're just spending money to get by, and that is what the Fed wants to see, because then you are not seeing, you know, all of these dollar amounts chasing different products, increasing the inflation. That's basically how the Fed thinks about this. But the economy has been pretty strong. Everything we've been seeing is that we are in a strong economy, and you can see right now as we approach the rate decision, you can see this red candle go down. And by the way, guys, I do have an order here, an open order on OKX, which is my favorite exchange. So this is at 19,800. I would be very careful right now. I know very well that we could see, you know, volatility like this, guys. We could literally see this. So if you're using leverage, you could very well be right on the like direction of the move, but then get stopped out. And by the way, guys, people are telling me to increase volumes for the music. Do you want me to increase the volume? Let me know down in the chat here. So I will be able to do that if you want me to do that. But be very careful trading this range, guys. But I know very well that we're gonna have volatility here. So I'm going to be watching this position like a hawk should I get this filled. So just want to point that out. Okay, so no one wants to, or most people do not want me to increase the, increase voice volume. Do you want me to increase, like, just let me know, like, if you think the sound is okay, just say the sound is perfect as it is. Increase voice, let me know, increase voice or music. So 300 basis points, yeah, that would be absolutely insane. So the voice is too low. Okay, so let me just see here. Let's increase the voice a little bit then. So I think I've increased the voice a little bit now. Is the voice better? Let me know that down in the chat. Okay, so it should be a little bit better now. So yeah, just let me know. But yeah, so I do have that buy order here. We will see if I am able to get that filled. I'm expecting massive volatility here, as we've been talking about. We do have one major thing to watch, of course. This is more on the like longer time frames. This is on the weekly, and that is that I want to see a break above this wedge here on the RSI. This is a big thing, guys. In every bear market or like a consolidation in a bear market into a bull market, we've seen like this kind of like pattern going down here. And yeah, breaking above this would be very, very nice indeed. As you know, I've been watching this. If you've been watching my channels, you already know about that. But yeah, we can see the markets are going down, guys. So So I guess, okay, we're going down. Not yet down here. Almost got that order filled, guys. I'm just going to watch the charts right now. I assume that we did get that 0.75 basis point rate hike, but I don't want to zoom out just yet. But I'm guessing it's all over Twitter already. But I just want to show you this volatility here. Okay, so it's confirmed. I'm just going to get into some of the stuff they're saying here in regards to the 0.75 basis point rate hike, which we have been seeing, guys. So it's completely as expected, which is good. This is what we want to see. But the Fed says it will take cumulative tightening and lags into account. And they also said that they need ongoing hikes until rates are sufficiently restrictive. And guys, by the way, just a reminder for new people, the Fed are going to, Jerome Powell he's going to have a press conference in a little while here. So we are going to watch that live. So make sure to stick around because this is the most important thing. Sure, we did get that rate hike as expected, but this is really the interesting stuff with the press conference. And you can see that the markets are pumping. The markets are already pumping above this dotted resistance line here. So that's absolutely fine. 75 basis points. When face reveal? Well, sooner than you think. I only request a nice bull run. Yeah, I think a lot of people are requesting that. So you can see the markets are pumping, which is absolutely fine. But given that the markets are pumping like this, of course, the chances of me filling this order down here drastically lowers. So it's drastically lower, of course. But luckily, I do have my little bot here. And let me see our bots on OKX. So this bot, as you know, when I made my video today, this was at like 0.5%. It's already up to almost 1% here. So that's cool. What else? So we're seeing a little bit of a pullback and you're just going to have a lot of volatility here. But I think during the speech, which is coming up very soon, that is when you're going to have the crazy volatility. So the range we have been trading in on this 4-hourly candle, it's within 3%, so between 20,100 and was that, yeah, 20,100 and 20,800. And it says major volatility will come at the press conference, and I 100% agree. Do you use stops with your bots? Actually, I do. With this particular bots, I did add a stop loss and take profit. As you can, I don't know if you can see it, but it's right here to the far right. And basically, so let me talk about the bot for a little bit since we're already discussing it a bit here. So the range for the bot right now is between my orange box here at 19,800 and the 21,800 range. So for as long as we are trading this range, the bot is going to essentially print money, so to speak. Not print money, but you know, it's gonna trade profitably within that range. But then I have a take profit and stop loss here. So should we ever go above the range down here and the range above here, I am going to have that bot being executed or closed, essentially. And that is what the take profit and stop loss are here for. And of course, if you want to join this bot, you can do so. What you need is a OKX account. And then if you want to get the exact settings as I have for this bot, by the way, links are in the description. Sign up for OKX first, and then you just click this link. You get the exact settings as the latest bot I'm having here. So yeah, and this is if you're from the US or any jurisdiction where OKX is not allowed. You do also have BITGET here where you are able to claim up to 8,400 in bonuses as well. So make sure to check out those links in the description. Hi from Puerto Rico. Wow, nice. How's the weather down there? Market get confused. Yeah, this is a very indecisive decisive candle here, but this is just what you're gonna get. Of course, people are like playing this, jumping into trades and whatnot. Of course, if you traded this, I mean, getting in at the orange line here, the resistance, or sorry, the support here at orange line, you were already sitting at like 2% at the high here. So that's not too bad. But did you get into a trade? I would love to hear you guys in the chat. Did you get into a trade or not? And maybe you're waiting for the press conference. Are you waiting for something else? Let me know what your strategy is right now in the chat. Do OKX have KYC? They have they don't have KYC as a requirement. I think you can withdraw like 2 Bitcoin if you don't have a KYC account on OKX. But other than that, of course, if you KYC, you have higher withdrawal limits. Can I use the same bot in Binance? I don't think so. At least not on the futures market. This is a futures bot, but you can also trade this. You don't have to use futures. You can use spot trading as well. But I just think that, you know, you're not gonna see, like, since you're trading within a range here, you're not gonna see insane gains. So this is why I'm using leverage to try to just amplify those gains a little bit. Because we're trading, remember, a very small range here. This is like a 2% range. No, it's more. But if we go up here, it's like from the bottom to the top, it's a 6% range. I did not get into a trade, still holding a bag since early 2021. That's cool. That's cool. Greetings from Holland. Watch your videos every day. Thanks for all the good work. Thank you. I appreciate that. What's happening? Should I buy or not? Not financial advice, of course, but what we can see here is that the markets are pumping, and I think in general, so as you know, I'm working on a long-term video I want to share with y'all. I'm just waiting for the Fed to have that press conference. I will try to get that video out within the next 2 days. So I'm hoping to have that out by then. But I think that within the next 3 to 6 months, the markets should be starting to go up here. Now, when we talk about a bottom, we talk about a bottom in price, but we also need to talk about the bottom in time, because of course, the longer we go sideways and the longer we've been trending down, the higher the likelihood of us then having that reversal and going up. But we can go sideways for quite a bit longer. But I do think in 3 to 6 months, I do think that we should be starting to coil up for that next bull market. Why is it going up when they raised rates? Well, because they raised rates, but they raised it exactly as predicted. So they raised 75 basis points. The market saw that, okay, we got that raised exactly as the market was predicting, and the market likes to be able to predict things. So the more we're able to have a heads up as to what the Fed are going to do moving into the next months, moving into the next few, the next year. If we could get the Fed saying exactly what they were going to do for the next 12 months, which they're obviously not going to tell us, and they don't even know it themselves yet. But if they told us something and they stuck to that, the markets would be pumping, because the market likes certainty. And we could see a short term, if they said, okay, we're gonna raise rates 5 more times, we could see a dump on the back of that, temporarily. But then, as the market price everything in, find its fair value bottom, then we would be starting to go up in time after that. What's my favorite game on Steam? I get some of the Europa Universalis. I like very much. It's a good game. I like Warcraft 3. Warcraft 3 is I still play it, so it's more than 20 years old, I think, by now. So let's talk about the dollar. A lot of people are talking about the DXY, and I showed you this chart today. This is actually a trading shot chart, but it's very nice. And you can see the dollar index here at the bottom. And whenever the dollar index goes down, in general, we go up. So you can see that the Bitcoin, this is basically since the inception of Bitcoin, As the dollar index went up here, Bitcoin went down, but then sideways, Bitcoin started to coil up for the next bull run. Dollar index went down, Bitcoin went up. And this has been the story. And I do think that we are getting into some sideways movement for the DXY. And yeah, I'm just like I said, like 3 to 6 months. And then I do believe it's time for us to have that, that bull run again in crypto. Yeah, this is a very interesting candle, guys. Very interesting indeed. And by the way, guys, if you were enjoying the content so far, if you are waiting for me to cover the FOMC press conference, where we are going to hear it straight from Jerome Powell himself, what the Fed believe is the next step of action here. That is going to be very volatile, but I am going to show you that as soon as we have that, guys. So make sure to stick around because this is very important. DXY is going to continue up. I don't think so. I don't think so. I mean, there's a very... Let me just get into the DXY while we are on it, actually. So let's see here. Let's go to the DXY chart. There we go. Let's go to the weekly time frame. And on the DXY, so the first thing is that if you've been watching my videos, you know that I've been talking about this key level being a logical point for the DXY to start going down. And we do have this also as a level to go. We didn't look at the traditional markets. Okay, the traditional markets are pumping here. So that's good to see. Let's go back to DXY. So these were logical points for the DXY to get the stop and reverse on and start going down. Now we did hit this first resistance line right here. And from that point, we've gone down. Now, I'm not ruling out us going down, potentially finding support here of my orange line. As you know, the DXY tends, or not to be arrogant or something, but most charts tend to respect my orange lines. Joke, but at the same time, kind of telling the truth as well. But hey, going up here, we could see a pump from the support level here, and then make a push towards this 120 DXY level. I'm not ruling that out, but at that point I do think that we are definitely at a local top. And why do I believe that? Well, this is a historical level. If we go to something like the monthly time frame, you can see, is that red line a speed fan? So look at this. We have not been at the same level as the orange line here since 2002. So, I mean, this is a key level. This is not something that we usually are at to begin with. So if we come up to this level, it's a key level of resistance. And it's a logical point for us to have that stop and reversal to the downside. Now, we already, of course, had it right here on the dotted line, as I showed you. But should we break to the red dotted line here, I do think that this is a key level to also keep watching. Now, I will say that we did have a breakthrough or a breakout from this level here in the 1983s. Here we did have a massive pump here in DXY, but of course those were different times as well. So yeah, that's what I believe. I don't think we're gonna go above this orange line here on the DXY. Do you think that we are gonna do it? Let me know down in the comment in the chat. What about the profit of your bots? Well, what do you know? What do you want to know about the profits? So my bot here, my recent bot is already up 1.1%, guys. So if you got into this bot, you are sitting at profit. Depending on when you got in, I gave you the heads up, and this is what, if you're new to my channel, guys, I always give you the heads up with whatever I'm doing, and usually it works out pretty well, but you know, there are times when my trades do not go as I hope them to be, okay? There are very few, those occasions, but I always want to show you, like, if I get wrecked, I show you I get wrecked, but I always tell you what I'm doing before I'm doing that. And this bot is already at profit. My previous bots, which I also showed you how to get in, I actually told you about these bots before I got into them as well, and they're all at profits. Now, they're at like 20%, 10, 8%, 15%. So it's not like life-changing amounts, but it's still like relatively, like, not trading is always risky, but from a risk to reward standpoint, I would say they are relatively safe. Okay, they're relatively safe because we're trading a range based off of my very important orange boxes and key levels here. And of course, also with this bot I have running right now, this have a stop loss and take profit. So at the very least, you're not gonna like lose significant amounts of money. Of course, small amounts can what is small amounts for some people could be significant amounts for someone else. What's up with my long order? Yeah, it didn't get triggered, guys. It happens. My long order here at 19,800 inside of my orange box didn't get triggered. But if you were like, I was very conservative here. If you were a little bit more drastic, you would go long here at my orange line instead. As you can see, this acted as massive support recently, but we still have a shot of getting this filled. Remember, we're gonna have the FOMC meeting. It hasn't started yet. We're gonna have it very, very soon, guys. And when Jerome Powell speaks, you're gonna see this flip, like, you're gonna see it be like flipper here, ping pong. So we could still see that getting filled. Talk about some good altcoins to pick up before the bull run. Actually, that's a very good good question. I am going to make a dedicated altcoin video very soon, like in a couple of days. So make sure to subscribe and activate the bell if you want to see that altcoin video. Can we do the same thing on Binance? Are most of your, like I said, I don't think that they have a futures grid bot. I don't think so. Let me know if they do. Are most of your bots neutral? These two bots are neutral, or these three bots are neutral. So I guess 50% of them are neutral. If you don't know what the difference is between a long bot, a short bot, and a neutral bot, make sure to watch one of my recent videos where I talk about that. And also make sure to join the Telegram channel. The Telegram channel is down in the description. Let me see here. Where do we have that? Yeah, this one. So this is right now, like, I only have limited spots for this, so make sure to join this right now if you want to be in the limited Telegram channel where I talk about all of this. I showed you the video here. I posted a video about exactly how to set up this bot as well. So every time I do take action, you're gonna see that in the Telegram group straight away. Litecoin, talk about Litecoin. To be honest, guys, Litecoin, I don't have that much to say about it. I just think that there are better opportunities out there from a fundamental perspective. I really don't see, and also pay attention to the amount of coins being launched right now, because some of the coins that are being launched right now are going to be the top performers in the next bull market. And the old coins are not necessarily the coins that do the best. In general, new coins actually perform better than old coins in general, in terms of like insane gains. And by the way, guys, if you want to join the OKX bot, of course, just like I said, you do have the link here in the description. Make sure to sign up using this link, where you're also able to claim up to $10,000, and you can get the exact settings by using this one right here. As always, not financial advice. Be very careful with trading. It's always risky. Do not trade with more than you are willing to lose. Satoshi, what is your thoughts on the new index of Bluebird USDT? So I think he's talking about that Binance index, which consists of Dogecoin, BNB, and Mask. And Mask is actually a very, like, it's crazy. It's like at 250th place, and it's let me see here. So Mask, okay, you can actually see it's one of the most, okay, it actually went up to 179th place. When I looked at it just now, it was at the 250th place. So it's been having a little bit of a pump here. Wow, quite a bit of a pump actually, 71%. But I was surprised that this was actually included. Dogecoin, okay, I can understand that. BNB, I can also understand it because it's a native coin of Binance, but Mask, of course, they are, if you go to the website of Mask, you can see that they are kind of like working on social networks and integrating their token and whatnot, but it was just like so far away, like on the 250th place. So yeah, I was a little bit surprised that they included such a small coin in that index, but hey, maybe it's gonna do well. So far it's doing pretty well anyway. Alejandro Castro, thanks for sharing your strategies, otherwise I would be wrecked. I appreciate that, thank you. I will always try to just give you my honest thoughts and let you know what I'm personally doing. And then we are at the mercy of the of the markets, of course. We're at the mercy of the Fed right now, but I think we've been doing pretty good, guys. I think we've been doing pretty good in general. So for those of you who have been with me since 2020 and 2021, of course, I appreciate all of you. I appreciate the new people as well, but for the people who have been around since 2020, I would say that a lot of you have probably done pretty well. Not only because of like my thoughts on the markets and whatnot, but also since you were in that bull run. So congratulations to getting into crypto so early. How much do you think until the bull run begins? Well, a lot of charts, guys, are pointing towards us. I think within the next 3 to 6 months, we should definitely be getting serious about preparing for the next bull market. And I mean, we do have, just like I said, we do have price and we do have time. We can have a bottoming in time, we can have a bottoming in price. Do I think that the bottoming in price have already hit? I think there's a decent chance that the bottom in price has already hit. Although I'm not ruling out us going down to this vicinity again, like at $17,000, $18,000. But if we do that, I don't think that we are going to go significantly lower than that. So buying at this vicinity, I don't think that that is a bad idea at all. Will the Fed stop the rate hikes after the this press conference? Maybe. We will find out. We need to watch what they're saying, guys. This is taking place very, very soon. As soon as it is taking place, I will flip over to the FOMC meeting, guys, and you can hear it for yourselves. So yeah, we do have, and also whenever we break above this on the RSI, I do think that that is also something key to pay attention to, because as I said, this is something you've been seeing traditionally in previous bull markets as well, or sorry, bear markets. Guys, if you're new to the channel, my name is Chris. I bring you cryptocurrency videos every day. Try to just teach people what I know. I try to share what I do. I try to make money in crypto, of course. So if that is something that you would like to do, and that is something you would be interested in, make sure to subscribe and activate the bell icon right now. I appreciate every single 271,000 one of you. So you're all unique to me, guys. So thank you so much for joining this beautiful community. What is Twitter saying? Are we going to... One guy I like to actually check out is Adam Cochran. Let's see if he put something out here. So, new sentence in the FOMC. Fed hikes by 75 basis points. So, let us see here. The committee, in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Okay, so we will find out more soon, guys. We will find out more when the Fed has their when they have their press conference. We believe that ongoing interest rate increases will be necessary to achieve sufficiently restrictive policy stance. The markets are not reacting bad to this so far, guys. We're seeing a pump still. Scott White says, I'm struggling to set up trading on OKX. Can I do it within England? To be honest, guys, I do not think that you're able to use OKX in England and the UK. I don't think so. But then you can use BitGet. I do think that BitGet also has a bot, a futures grid trading bot. And I will show you that here very, very soon. So how to set that up in a similar manner as OKX. The thing about the grid bot on BITGET, from what I've heard, is that you're not able to go neutral on them. But nonetheless, I will show you how to set that up on BITGET as well. And BITGET should be available in the UK. So make sure to use this link if you want to claim up to $8,400. And for the first 150 people also, you get an additional like $400 if you sign up using that link. So up to $8,000 plus $400. And make sure to sign up for BITGET in that case if you're not able to sign up for OKX. Andras Clemenc, I follow you for more than 1 year and a half. At that time, you said, I hope next month we will be at 100,000 followers on this channel. 271 right now. Yeah, thank you for following. Doing my best here. I hope that you have been getting value out of the last couple of years you've been following. So when does Jerome Powell start to speak? He should be starting the speech in about 4 minutes, guys. So in about 4 minutes, we're gonna see that speech. So do not go anywhere. This is very important to keep watching here. So I will flip that on as soon as we do see that. I will turn off the music and everything, of course, so we can hear what he has to say. Show the 1 minute chart. Shall we do a 1 minute chart? We can do that during the FOMC meeting for sure. Let us do the 1 minute chart. There we go. 1 minute. Do you think that Powell will crash Bitcoin down to $19,000? Could happen. Could happen. In that case, I have my I have my buy order down here. So if I get that executed, I will be pretty happy. Because I do think that unless we see something absolutely insane, I still think that this is going to hold, guys. 19,000, my orange box here. I've been having faith in my orange boxes since I started trading, and so far it's been going pretty well. So I have no reason to believe that we're just gonna crash straight through this. Of course, it could happen. I mean, if it goes into a, if it really wants to crash the market, it could happen. But I do think that there's a, like on a risk to reward standpoint, getting in at the trade here. Of course, be very careful, but I'm going to take that shot. We will see, or you will see if I get wrecked or not in a bit. What else do we have? 1 second chart. 1 second chart. That would be absolutely insane. Do we have a? Yes, we do have a 1 second. No, this is too much, guys. This is too much. We can't do 1 second. Wow. Jerome Powell will crush his soul just to stick to his policies. Wonka says, thank you for giving a shout about Celsius, Chris, back in June. So what you're referring to is me warning about Celsius potentially being bankrupt before they started to halt withdrawals and stuff. So yeah, I'm pretty proud of that, actually. I gave my audience a good at least like 5-10 days to withdraw their crypto from Celsius. I actually started to hear from some of my people, like my friends who actually have good knowledge behind the scenes about what's going on, and they told me like, hey, you need to withdraw everything from Celsius right now. And so that is when I also made that video about withdrawing from Celsius. I don't like Moonboy videos. I appreciate your videos, quite objective. Josip Vuleta says that. You know, the funny thing is that some people still call me a Moonboy. Some people call me like a doomsayer, so I mean, you cannot please everyone, I guess. But yeah, I appreciate that. So Elon Musk has been saying something. Let's see, guys. Did he change this? I guess he did. What does this mean? Twitter complaint hotline operator. You get what you pay for, definitely. Obviously talking about that $20 to get verified. 1 minute until Jerome Powell speaks. Yes, make sure to stick around, guys. This is going to be very interesting. Rennie Sam says, why are you ignoring me? Bro, I am not ignoring you. Okay, so we got it. Let me turn off the music. Let's see here. This is probably not... Okay, so I'm gonna keep this. He has not come out yet, guys, but I'm gonna keep it like this. And I'm gonna keep this on the 1 minute chart. You can see that we're starting a little breakout here. So let's see whenever he comes out. Could be a little while still, but I'm still going to keep this here. And when he starts speaking, guys, make sure to let me know if the sound is okay. So there we go. They have at least started the broadcast. So now we're just waiting for him to come out. Doesn't usually take that long. And here we go. So, hope you got your seatbelts strapped on, guys.
Good afternoon. My
Please pump it,
colleagues and
sir.
I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy.
I increased it a bit. Let me know if it's okay now.
The economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year.
I will let him speak and I will give you my thoughts.
Inflation remains well above our longer run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go.
Big red count.
And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Oof.
Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
Wow.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby.
Wow, okay, so a bit more hawkish, negative towards the market.
Thank you, Colby
than
Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation.
We just erased our gains.
Taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
You want to see something even more dramatic?
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may. and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement, because that really does become the important question we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September
Higher
meeting.
levels.
That level is very uncertain, though, and I would say
that's very bad for the markets.
We're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming. And it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead,
S&P 500.
and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program that we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Temeros of the Wall Street Journal. Chair Powell, core BCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Guys, make sure to stick around. I will let you know my exact thoughts once.
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy, whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this, it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to
there you go.
to that level of sufficiently restrictive, and we don't, of course, we don't really know exactly where that is. We have a sense,
They're gonna
and
keep
we'll write
raising
down
rates?
in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. Sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a
wants to get a new
balance
house
between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't present doesn't appear to present financial stability issues. But no, we do understand that that's really where a very big effect of our policies is.
Will it hold? Yes or no in the live chat on the 1 minute?
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the
does not
vacancy
believe
and
it is gonna
unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line, but so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be
Never
consistent
underestimate
over
my orange
time
line.
with 2% inflation, assuming a reasonable productivity. There with
will
the,
probably break it soon,
with the
though.
ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down. The compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds, sort of the level that would hold the market where it is. So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought.
Supported
Because,
here,
and that, the
went
data
up,
series is
rejected,
volatile. We never take any one
and now
reading.
in the
We
middle.
always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, I guess as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Guys, if you enjoyed this orange line holding up the Bitcoin price here, like the video and subscribe.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our
even held on traditional markets,
foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time.
Let's see, it's
price
probably
stability
one
is
question
the
or
kind of
two
thing
questions more,
that pays
then I will let
dividends
you know
for
exactly
our
what I think
economy
about this.
for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep, longer-term inflation expectations anchored and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marti with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of us, one of the policymakers, violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio.
Are going to be
earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. that curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread, you're right. And that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it. You have to go back in.
Guys, make sure to stick around until the end.
The risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put greater weight on that in order to ascertain things like whether there's over-tightening going on?
Stick around until the end, guys.
Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of, it's a reweighting of tenant rents. The private measures are of course good at picking up at the margin, the new leases. And, they tell you a couple things. One thing is, I think.
So yeah,
right
stick
now,
around till the end. I just don't know when the end is going to be.
Of the new
We'll see. Markets are pumping.
It's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you wanted to see? Is that a
Positively.
problem, or how much that might
How is this a
affect your future
positive
policy
reaction?
to see this positive reaction?
You know, we're not targeting any one or two particular things. You know, our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, you know, the pattern has been that one after another, they go up, and, you know, that'll end when it ends, but
This is
there's no
positively,
sense that you know, that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
You know, in theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to wage to sort of counter.
Okay, I'm going to let him answer this last one, and I will.
Consumer spending is still positive. It's at
probably
pretty
cut him
modest
and
growth
talk about
levels.
what I think about this.
It's not shrinking, and you know, people are, and you know, the banks that deal with retail customers, and many retailers will tell you that the consumers are still buying, and they're still, you know, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
So what about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
You know, it's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that, you know, our job is going to require
I will stay
some
with the
resolve
conference.
and some
It's just
patience
like,
over time. We're going to have to stick with this.
It's getting late, you know.
You know, that's just, we take all that as a given, but we know what our objective is, and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to, ordinarily there's a relationship to GDP going down and vacancies declining. translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies.
Sebastian,
we think
Fischot,
on a very steep part of the beverage curve.
I will let you know my thoughts before I close the stream, yes.
The job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now, and it really hasn't. Although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Okay, there we go. So, at the end, we pretty much, if we just zoom out here, you can see that we're getting support here of my red line on the 1 minute chart, which I do not advise people to trade, but hey, it's been funny watching this. But on the 4-hourly time frame, we are pretty much at the same point in which we have been at for the last few days. But the thing is that we've been having these swings. Look at this ridiculous candle here. So that's the first thing. The markets, they just went nuts for a bit here, but we're still at the same price point, which is very interesting. So what he did say, though, is that he is expecting to potentially continue to increase the rate hikes more than he was expecting previously. So basically, when he's been talking months ago, that is basically out of the window. They are probably going to keep raising rates. Now, remember, we were expecting 0.75% this meeting, which we got, and then a 0.5. In fact, let's see here if they have updated what we expect for the next one. So is this for current rate 300? So for the next one, we're expecting a 0.5. But then the market was kind of expecting that to be it, because that would be in line with the interest rates they were targeting. But now he's opening up for more rate hikes, basically. What else did he say? Of course, he continues to watch the data that comes out, like the labor market and so on. So for as long as the economy is not being crushed, which it's not right now, the market is, the economy is still pretty strong. So for as long as the market is still pretty strong, he's going to be but he's going to be ruthless, so to speak. He's going to continue to drop that. But the thing is, so this is where my logical mind comes in. They cannot raise rates that much more, because it would just the housing market would collapse. People, they just, from a logical perspective, they cannot do that much more. So it's basically scare tactic. He wants people to stop spending money, okay? He wants people to stop spending money so the inflation can go down. But he's gonna do whatever he can to push that down, basically. So let's look at some of the comments, because I do probably have some quotes here as well before we wrap this up, guys. And guys, I hope that you have been enjoying, we're not done yet, but I hope that you've been enjoying this. So slow down sometime, maybe 50 basis points in December, which I'm expecting. Terminal rate higher, so he's expecting to have a higher rate than what he has been communicating previously. Premature to even talk about pausing, so it's too early to talk about pausing. Expect more rate hikes. Soft landing still possible, but narrowing. Interesting. Recession, I don't know. Well, a recession is most likely going to happen. We just don't know how long it's going to be. Could be a short recession. So basically that's what he talked about, guys. This is what we got from him today. I'm going to, of course, keep you updated. If you enjoyed today's live stream, make sure to subscribe, activate the bell icon. If you want, let's look at the bot here real quick. The bot is already up like almost at 2%, guys, my OKX bot. So for everyone who joined the OKX bot, you can close that trade at the 2%, almost a 2% profit right now, which is, yeah, it's 2%. So, you know, you're probably not going to be able to buy a house with it. But maybe if the Fed continues to increase the rate hikes, you might be able to buy a house with that profit soon. If you want to go into this trade, as usual, guys, you do have all of the links in the description. Make sure to sign up for OKX here first, up to $10,000 in a bonus here. And then you got exact settings for that bot right here as well if you want to join that. If you are not able to use OKX based on the country you live in, you also got BITGET, which is most likely available in your country. You are able to claim up to $8,400 there. Guys, that's what I got for you. As usual, a new video tomorrow. And yeah, hope that you are going to enjoy the rest of the evening. Thank you.